Did you know that your bank or mortgage company is absolutely ripping you off? If you look at your mortgage statement at the beginning of your loan, you're going to see that the amount of interest you're paying is going to be exorbitant. You're just going to pay a very small amount of actual principal. So it takes you forever to pay down the loan. Why does this happen? So, if you want to understand mortgage interest and how you can actually cut the amount that you're going to pay, be sure to stay tuned. So, if you're wondering how mortgage interest works, it's a very simple computation, and it's basically the principal times the rate is going to give you the amount of annual interest that you have to pay. And then you divide that number by 12, which gives you the monthly amount of interest that you'll have to pay. And I'm going to show you how prepaying a little bit of your mortgage principal can impact the amount of interest you're going to pay over time. So, for all of our examples, we're going to assume a purchase price of $250,000. And in some parts of the country, that's going to get you basically nothing or something really, really horrible. And in other parts of the country, that'll get you something fairly good. We're going to assume that you got a 20% down payment, so you're going to be borrowing $200,000. Most people recommend that you actually put 20% down. That allows you to avoid PMI or mortgage insurance, which basically goes to benefit the lender. It doesn't benefit you at all. It actually hurts you because it takes money out of your pocket. For all of these examples, we're going to be going with a 7.43 interest rate. Unfortunately, that's pretty stinking close to what interest rates are now. It's pretty sad. A year and a half ago, they were around 3 or 4%, but things have changed over time. So anyway, when you get a mortgage statement, you're going to see various things. You're going to see probably 4 different things that you're going to be paying. Number one is going to be principal. Number two is going to be interest, and sometimes it'll be lumped under principal and interest. You'll also have to pay property taxes to the county in which you live, and also homeowners insurance. Now, this is not mortgage insurance that basically protects the loan. This is insurance that insures the property itself. So if there's a fire, flood damage, in some instances, most of the time you're going to have to get a separate flood insurance policy. But fire damage, wind damage, hurricane, tornado, all sorts of things, hail damage, you will be protected. Your investment will be protected. So you're going to see these things. And the thing that we're really going to worry about today is the principal and interest. And when you go in and look at the principal and interest for this loan of $200,000 with a 30-year term and 7.43 interest rate, you're going to get a principal and interest of $1,388, as you can see on the screen here. Now, what you want to do is you want to go into this amortization schedule, and that'll tell you some things about the loan. Since today is August 10th, 2023, when I'm recording this, the payoff date will be in August of 2053. The first payment will be due probably on September 1st. Note the loan amount, $200,000. The total interest paid, if you pay just the minimum, that $1,388 a month, you're going to pay over $300,000 of interest. Okay, so the total loan cost will be $500,000. So fully, you're going to pay 1.5 times as much in interest as you are in actually paying off the house. You've paid more in interest than the actual price of the house. Hopefully, in the future, you'll be able to refinance to a lower rate. Nobody knows which direction rates are going to go, so you may not be able to do that. This is if you pay the minimum and don't change the terms of the loan. So if we scroll down, we'll have every year between 2023 and 2053 available, and we can click on these little plus signs, and it will open up and show you how much you're paying each month and how much you're paying down. So the first month, you're going to pay that $1,388, and only about $150 is actually going to go towards paying off the principal amount of the loan. The rest is going to interest. And this is why people think that you're going to be getting ripped off by the bank. But keep in mind, $200,000 times 7.5% will be $15,000 in interest. You're paying slightly less than that, but pretty stinking close. So $1,500. I'm sorry, $15,000 a year. That's $1,250 a month. And look at what we've got. It's pretty close there. So you will decrease the amount of outstanding balance at this point, and instead of owing $200,000, you're going to owe $199,850. So when the bank goes to calculate the interest the next month, they're going to use the new balance and then charge the 7.43% on that. So you'll note that the amount on this October 2023 line that you're paying, you're now over $150. So it was $149.67. Now you're paying almost $1 more per month, and your balance will drop. That will become the new amount that they're going to base the interest charge on. Now, look at what happens down toward the end. So you were paying, $1,200, $1,250 a month in interest charges. Now, when you get down to the last year, we only owe $10,500, and that $1,388, they're only charging you on interest on the $10,000. That will be $700 or so a month, or I'm sorry, a year. So you can see that you're getting only $73.57 in mortgage interest for the year. And you are paying a whole lot towards the principal. The bank's not ripping you off. They're just charging you 7.43% on the outstanding balance. And as the balance gets paid down, the amount of interest you're paying each month goes down along with it. So there's nothing shady going on. That's just the way that mortgage interest works. Now, after thinking about that, you can actually save interest costs by paying your amount of the mortgage down a little bit more rapidly, and that's where we want to go next. So if you've enjoyed the video to this point, be sure and just very lightly tap that like button. It would really help the channel out a lot. I would appreciate it. And also, if you haven't done it already, I would encourage you to subscribe to the channel. I talk about things like personal finance and travel card hacking a lot on this channel. Also, I will post videos about places that I have been, and if it's tied into travel hacking or personal finance, then we get the interplay there. But hopefully this video has helped you learn about mortgage interest. Now we're going to look at how paying ahead can actually save you thousands of dollars over the life of the loan. So let's get back to it. I have decided to switch from Bankrate. The website with the extra payments was getting kind of wonky and taking out the amount twice and giving me skewed results. So I decided to go to this total mortgage because it's the first one that I found that actually works the way I wanted it to. And you'll note over here that the terms are the same. The principal is $200,000, 30-year loan term, 7.43% interest rate, originating in September of 2023. Note, monthly payment still $1,388. Total interest still right at $300,000. Paying it off in August of 2053 as we were before. Now we're going to add a $10,000 extra payment with a couple of dates. So the first date that we're going to use is toward the end of the term of the loan, 2049. So in this scenario, we pay $10,000, and we have now dropped the interest that we pay by $3,021.84 and shortened the term of the loan by 8 months. You're not saving a lot in interest because you're paying relatively little interest every month because the actual balance you have outstanding is a lot lower than it is when you started. So if we move to where we actually make the payment in a year instead of, 20 some years in the future, we cut $62,000 of interest payments off, and we cut 4 years and 3 months off. So an additional 3.5 years, an additional $59,000 of interest that we don't have to pay because we have jumped down the amortization schedule so much. So if we show this amortization schedule for the year that we're talking about, 2024, see, we got a $1,388 payment, and we're only paying, a little over 10% of the payment towards the principal. And by September, when we pay that extra $10,000, the regular payment, $162 is going to paying down the principal. Now you pay the $10,000, drop the balance outstanding from 197, almost 198 down to 188 roughly. And now you jump from 162 going towards principal every month to $225 every month going to principal. And you save that $60,000 in that way. So hopefully this gives you an idea of how paying extra on your mortgage principal, making a lump sum, can benefit you in terms of cutting interest down. Obviously, you could choose to invest that money, maybe make more. That's something for you to discuss with your financial advisor. But hopefully, this video showed you how you can actually save money on your interest and how mortgage interest works. So, if it has been beneficial, again, please just lightly tap that like button and hit the subscribe button. And thanks for watching.